A recession is a period of economic downturn, typically marked by a decline in gross domestic product. A recession is generally considered to occur when a country's GDP falls for 2 consecutive quarters or more. Other indicators of a recession may include a decline in industrial production, a decrease in retail sales, a drop in stock prices, and an increase in the number of bankruptcies. Recessions can have a range of negative impacts on individuals, businesses, and the economy as a whole. Some of the main impacts of a recession may include unemployment. Recessions are often accompanied by a rise in unemployment as businesses cut back on hiring and may even lay off workers. This can lead to financial hardship for individuals and families and can have long-term effects on career prospects and earning potential. Decreased income. Individuals and families may see a decline in their incomes during a recession, either as a result of job loss or wage cuts. This can make it more difficult to pay bills and meet financial obligations. Decreased business activity. A recession can lead to a decline in business activity, as companies may see a drop in demand for their products and services. This can result in reduced profits, layoffs, and even business failures. Decreased housing values. A recession can also lead to a decline in housing values, as the demand for homes may fall and homeowners may struggle to make mortgage payments. Increased poverty. A recession can exacerbate poverty, as job losses and decreased income may push more people into financial hardship. Decreased government revenues. A recession can also lead to a decline in government revenues, as tax collections may fall and social welfare spending may increase. This can make it more difficult for governments to fund essential services and programs. Overall, recessions can have significant and long-lasting economic and social consequences, and it is important for governments and central banks to take measures to stimulate economic growth and mitigate their impacts. Inflation and recession are two economic concepts that are often discussed in relation to each other. Inflation is an increase in the overall price level of goods and services in an economy over a period of time. It is measured as the percentage change in the price index over a certain period. When prices are rising, the purchasing power of a unit of currency, such as a dollar, decreases. For example, if the inflation rate is 2% per year, it means that a basket of goods that cost $100 this year will cost about $102 next year. A recession, on the other hand, is a period of economic downturn characterized by declining gross domestic product, high unemployment, and stagnant or falling prices. A recession can be caused by a variety of factors, including a drop in consumer spending, a decline in business investment, and financial crisis. In general, inflation and recession are considered to be opposites. When inflation is high, the economy is usually doing well, and when there is a recession, prices tend to fall or remain stagnant. However, it is possible for both inflation and recession to occur at the same time, in what is known as stagflation. This can happen when there is a significant slowdown in economic activity, but the central bank continues to print money, leading to rising prices.
But the bigger and most important question is, how do you remain rich during these tough times?
To understand this, you firstly need to understand what exactly is investment and the level of risk every investment is involved with. The hierarchy of investment refers to the order in which different types of investments are typically considered, based on their level of risk and potential return. The hierarchy is generally arranged from the least risky investments at the bottom to the most risky at the top, with each level offering the potential for higher returns as the risk level increases. Here is a general outline of the hierarchy of investment. 1. Cash and cash equivalents. These are investments that are considered to be very safe, with little to no risk of loss of principal. They include savings accounts. These are accounts offered by banks and credit unions that allow you to deposit money and earn a small amount of interest. They are government insured, meaning that the government guarantees your deposits up to a certain amount. Money market accounts. These are similar to savings accounts, but they often offer higher interest rates and may have slightly higher minimum balance requirements. They are also state insured. Short-term government bonds. These are bonds issued by the government that have a maturity of 1 year or less. They are considered to be very safe because they are backed by the full faith and credit of the government. 2. Fixed income investments. These are investments that provide a fixed return, typically in the form of interest payments. They include corporate bonds. These are bonds issued by companies to raise money for business operations. They offer a fixed rate of interest and are backed by the company's assets. Government bonds. These are bonds issued by the government to raise money for various purposes. They offer a fixed rate of interest and are backed by the full faith and credit of the government. Municipal bonds. These are bonds issued by state and local governments to finance public projects such as schools and roads. They offer a fixed rate of interest and are backed by the issuing government. 3. Equities. These are investments in stocks, either individually or through mutual funds or exchange-traded funds. They offer the potential for higher returns but also higher risk. Examples of equities include individual stocks. These are shares of ownership in a specific company. They offer the potential for high returns if the company performs well, but they also carry the risk of significant losses if the company performs poorly. Mutual funds. These are investment vehicles that pool money from many investors and use it to buy a diversified portfolio of stocks, bonds, or other securities. They offer the potential for higher returns than cash and cash equivalents, but also carry the risk of loss of principal. Exchange-traded funds. These are investment vehicles that track the performance of a particular market index, such as the S&P 500. They offer the potential for higher returns than cash and cash equivalents, but also carry the risk of loss of principal. 4. Alternative investments. These are investments in assets that are not traditional investments, such as real estate, commodities, and hedge funds. They may offer the potential for high returns but also carry a high level of risk. Examples of alternative investments include real estate. This includes investments in physical property, such as rental properties or vacation homes. They offer the potential for rental income and appreciation in value, but also carry the risk of loss of principal and the need for ongoing maintenance and management. Commodities. These are raw materials or other goods that are traded on financial markets, such as gold, oil, or agricultural products. They offer the potential for price appreciation, but also carry the risk of significant price fluctuations. Hedge funds. These are investment vehicles that use a variety of strategies, including leverage and short selling, to try to generate high returns. They are generally only available to accredited investors and carry a high level of risk.
Now, the biggest concern is how to make money during inflation.
Becoming rich during a recession can be difficult, as economic downturns tend to be associated with reduced economic activity, lower levels of spending, and higher unemployment. That being said, there are a few strategies that you can consider to try to increase your wealth during a recession. Look for opportunities in sectors that are less affected by the recession. Some industries and sectors tend to be more resilient during a recession, such as healthcare, utilities, and certain types of technology. Consider investing in or starting a business in one of these sectors, or look for employment opportunities in these areas. Take advantage of low prices. During a recession, asset prices, such as stocks and real estate, may be lower than they otherwise would be. This could present an opportunity to buy assets at a discount and potentially sell them for a profit when the economy recovers. Consider starting a side business. If you're able to, starting a small business or offering your services as a freelancer or consultant can be a way to increase your income during a recession. Build up your emergency fund. Having a cash reserve can help you weather financial storms, such as a recession, and reduce the need to borrow money during times of economic hardship. Try to save up enough money to cover at least 3 to 6 months' worth of expenses. Stay informed and be proactive. Keep an eye on economic news and developments, and be proactive in managing your finances. This might include things like reviewing your budget regularly, negotiating lower rates on loans or credit cards, or seeking professional financial advice if needed. As Warren Buffett says, be fearful when others are greedy and be greedy when others are fearful. It is a piece of advice that is meant to encourage people to think independently and to be cautious when making investment decisions. When others are greedy and eagerly buy into an investment or market, it could be a sign that the asset is overvalued and that there is a bubble about to burst. On the other hand, when others are fearful and selling off their investments, it could be an opportunity to buy into the market at a discounted price. It is important to remember, however, that this is only one piece of advice and that making investment decisions requires careful consideration of a variety of factors. Buffett also adds that non-professionals should simply invest in a cross-section of businesses and that a lost-cost S&P 500 index fund will achieve this goal. An index fund, as the name implies, simply holds all of the assets in the index that it attempts to track. Buffett revealed that he stipulates that 90% of the money should be invested in a low-cost S&P 500 index fund with 10% in short-term government bonds. Warren Buffett has quoted many times that no matter how great the talent or efforts are, some things just take time. There are limits to what can be achieved in a short period of time, and some things require patience and perseverance to come to fruition. This can be especially true when it comes to personal and professional goals that require a lot of hard work and dedication. While it is important to be proactive and to put an effort towards achieving your goals, it is also important to be realistic about what can be accomplished in a given time frame. Hope you have liked this video. Please like and subscribe to the channel.